Money, money, money. Listen up. I've got some news that's sending shockwaves through the commercial real estate industry. Brace yourselves, because a banking crisis is looming, and it's the last thing property owners need right now, as you can imagine. Here's the deal. Property owners around the country were already feeling the squeeze from the Federal Reserve's interest rate hikes, which raised their borrowing costs and lowered building values. And with more people working from home, there's a ton of empty space in city centers, putting even more pressure on commercial landlords. But there's more. Now, beleaguered banks, especially the smaller ones, could get even more aggressive with their lending arrangements, which might leave landlords with even less breathing room to refinance the huge mountain of loans coming due. Not good. According to TREP, roughly $270 billion in commercial mortgages held by banks are set to expire this year alone, with a whopping $1.4 trillion due over the next 5 years. And as First American's senior commercial real estate economist Xander Snyder told Yahoo Finance, access to capital was getting scarcer, and this banking crisis is almost certainly going to compound that. So, who's feeling the most heat? Well, it's the small to mid-sized banks that hold most of the commercial real estate mortgages. And guess what? They're the ones experiencing the most pressure during the current crisis. Just as Silicon Valley Bank and Signature Bank, both of whom have already failed spectacularly, as you know. But it goes further. The pressure on regional banks is only getting worse, with even German lender Deutsche Bank feeling the heat. Smaller banks started ramping up their exposure to commercial real estate after the 2008 financial crisis. And even after the pandemic emptied out many city center properties, they still stuck with it. And now, more than 80% of all commercial real estate loans are held by banks with fewer than $250 billion in assets. That's a lot of dough. BlackRock Global fixed income CIO Rick Ryder warned that raising interest rates this quickly creates stress on the interest-sensitive parts of the economy, particularly where there's financing or leverage attached to it. It's not all doom and gloom, though. Commercial real estate doesn't pose the same type of systematic risk the economy as housing did during the 2008 financial crisis. But there are isolated pockets that can lead to contagion risk, according to Ryder. So basically, we're not all going to be living in tents, but some folks might have to sell their trophy buildings at a little bit of a discount, or perhaps a steep one. And as for the banks, well, they're already squeezing terms on commercial real estate loans. Nearly 60% of banks reported tighter lending standards in January for non-residential and multifamily property loans, according to the Federal Reserve's latest Senior Loan Officer Opinion Survey. And with new bank stresses on the horizon, more tightening of lending standards is expected, which could slow economic growth this year. Oh, great. But don't worry too much. The Fed Chair, Jerome Powell, assures us that the banking system is strong, sound, resilient, and well capitalized. Whew, that is a relief. All in all, it's been a wild ride for the commercial real estate industry over the past few years, from the pandemic-induced shutdowns to rapid recovery to massive financial tightening. It's been a real roller coaster. And now, with a banking crisis looming, well, the ride is far from over. Hold on tight, folks. Let me know what you think about this latest development by commenting below. And don't forget, as always, to follow, thumbs up, like, and subscribe for more updates on the wild world of finance. Thanks for tuning in.